Right, traders, welcome back to this S&P 500 case study where we're going to be diving into the aspects or the overall principles of order blocks, right? So quickly to recap, before we go on to the live price action analysis, we're going to ask ourselves, what is it that makes an order block, right? What makes an order block? What makes an order block, right? So the things that make an order block, we need three things that actually validate an order block itself, right? Three things. It must break something, i.e., it must break structure, it must leave a fair value gap, and it must be priced in the premium or the discount. So the PD arrays become very important. And this is something we're going to dive into a lot of detail in this video. Okay, so here we have the S&P 500. Now, the first thing I do with any market is I like to understand things based off the four pillars. So what are the four pillars that we often discuss, right? So the four pillars we discuss are, you want to be looking at market structure, you want to look at your dealing range, which dealing range are we currently in? You then want to analyze your PD arrays, your premium and discount arrays, and then we look at inefficiencies or fair value gaps, or in this case, we look at a gap up in the markets. So once we've established this, from here, the thing to understand now is our market structure. So we're going to be looking at a sell from last Thursday, so the 20th of June. So the way that I look at the market structure is quite simple. We have a structural high over here in blue. So we have a structural high. Now we have a structural low. And now from here we saw a structural high up here. So from here we're essentially playing the pullback on Thursday. So this is our structural low, this is our structural high. Our dealing range consists of this swing low up to this swing high. And the overall narrative of this trade was to look for a retracement. Yes, we didn't come into the pre-discount exactly, but we're still looking to play a correction using the order block theory. But before we get onto order blocks, we want to ask ourselves, what is it that makes this trade high probability? What makes it valid? Well, the answer lies in both time and liquidity, right? So what we have over here is we have price opening up from Monday. So we have the Sunday open, which is roughly this red line over here. Notice how this red line over here represents the weekly opening price, so WO for short. This is the weekly opening price. Let's label that weekly opening. So now that we have the weekly opening price set in stone, we understand that we are significantly above the weekly open on Thursday, right? So from here on Thursday, what do we see, right? So Thursday, London session saw us, so this is 8:30 UK time, 8:30 a.m. UK time, so that's 3:30 a.m. Eastern Standard Time. We see London head up, give us our manipulation. This is a bullish manipulation. This is essentially our Judas swing, right? So let's label that in yellow. This is an ICT Judas swing, and it represents the overall manipulation in price. What makes this a high probability Judas swing? Why do we expect somewhat of a reversal or a correction from this particular zone? So there's a few things that make this high probability. The first thing is that it's above the weekly opening. This is very important. A great rule of thumb to understand for a lot of traders is that if you could buy below the weekly opening and sell above the weekly opening, your strike rate will increase massively. And this is a big part of my trading success over the last few years, was understanding that price should be above the weekly opening to look for sells and should be below the weekly opening to look for buys. Kind of analogous to the premium and discount array theory. So once we understand we're above the weekly opening price, the next thing that validates a Judas swing is that it must break something, i.e. it must break structure. There must be a swing structure that's broken in the process. That's another thing that validates the Judas swing. Another thing that validates the Judas swing is that it must sweep liquidity of some sort. And we're going to be going into liquidity in a little bit of detail right now. So it must be above the weekly opening, it must break structure and sweep some sort of liquidity. And this is exactly what we're going to go into now, the concept of liquidity. Because there's two specific areas liquidity has been swept, right? This is a previous day high. We're going to call this a PDH for short, right? A previous day high. The second thing we want to look at is we want to look at the Asian range session. So this is the ARH or the Asian range high. Both of these are liquidity pools that have been swept in the market. And this is what validates the Judas swing further, that it has swept major pools of liquidity. a previous day high, and a session high, in this case an Asian range. So this now was the Judas swing, right? Valid for this particular trade. And now from here, the next thing you want to understand is you want to understand what actually validates things from an order block perspective, right? So notice how we have price breaking structure over here. So this becomes our market structure shift, MSS or BOS. It's the same overall principle, right? Once we have a market structure shift, right, the second thing we're looking for, if we go back to our rules of an order block, what makes an order block, right? We're looking for a shift of market structure or a break of structure. Those two things can be, those two words can be used interchangeably. Once we've identified a break of structure, what we're looking for now is we're looking for an inefficiency in price, right? So where is the inefficiency? And the thing to understand is that this fair value gap must be time-based, right? What do we mean by that? A time-based fair value gap is what we're looking for, right? So this is the S&P 500. So the volatility really kicks in the AM New York session, right? So people often ask me, where do we look for our fair value gaps with the S&P 500, right? So just to label this, this is the fair value gap over here. So if I label that for people so they can see, the fair value gap over here occurred just over here. So we're going to label that in dark blue. So this is the fair value gap that we're essentially keying off, right? So once we identify the fair value gap, right, the fair value gap must occur during a specific time region, right? So for the S&P 500, this also applies for the NASDAQ and the US 30. The fair value gap must occur between 9:30 a.m. So again, this is the opening time, 9:30 a.m. to 11 a.m. This is your key zones when it comes to looking for high probability based, time-based fair value gaps. What makes a fair value gap high probability? It must occur during a specific time window. Your analysis before that must be correct, i.e., we're above the weekly open, etc., etc. We're looking for a time-based fair value gap to key off, right? Now, once we've identified that, the next thing we look at, if you remember from our three rules, we've had a break of structure, we've had a fair value gap in our time window. The next concept we're looking for is we're looking for a premium and discount array, right? A PD array. And in this case, because we're selling, we want to be selling in a premium down to a discount. So the idea is to sell in a premium itself. And this is what this case study looks to identify. High probability order blocks, right? So once we've identified that, the next thing we look at is we look at the dealing range, which left the fair value gap, right? So from here, again, a quick look at this. We have a swing high up here and we have a swing low down here, just like this. On lower time frames, you're able to see this in more detail. For the simplicity of this case study, we're going to stick to the 15-minute time frame. But this is what you need to understand in price, right? Put things together. Yes, we've had a break of structure over here. So we've had bearish, we've had bullish structure, shift to bearish. So we've had a shift of market structure. We've now been given that time-based fair value gap, right? So we have a time-based FVG, right? Fair value gap. The last thing we're looking for is we're looking for price to come up above a 50% level before heading lower. And this is the key to understanding high probability fair value gaps, right? So from here again, short position, again, we're keying off that fair value gap. Notice how we're above the 50% level. Stop loss placement, again, for me, I prefer to have slightly wider stop losses. Some people prefer to have them here. I personally had it around this sort of level over here, giving my trades some room to breathe. Very important. You don't want to suffocate your trades. But once we understand the overall narrative of the markets, we're looking to sell above the weekly opening, targeting areas of inefficiency below us, targeting areas of liquidity. The thing to understand from here is that we're keying off an FVG. We're keying off an FVG in the New York AM session. We've had a switch of market structure or a shift of market structure from bullish to bearish, and we are above that weekly opening price. Very, very important to understand. We're above that weekly opening price, so we're positioned to take sells, right? Another thing to add to this list is that we've swept previous day liquidity. We've swept the PDH or the previous day high over here in this region over here. So with all the rules ticked, a question I often get within the community is, where should I target, right? Where should I target? A lot of people ask me, where do I target? Targets are very important. You can't just aim for 1 to 20 all the time because that's very unrealistic. But where as a trader do you actually want to target? Well, the thing you want to consider is, yes, we swept a previous day high, right? So this is a PDH, right? We look for the previous day high, PDH, previous day high. Now from here, we want to be targeting a previous day low, or we want to be targeting liquidity as a whole. So the next place I had to target was essentially this area over here. So this was Tuesday's low, right? So we've swept Wednesday's high. Notice how we have a large bunch of liquidity over here, trendline liquidity. Very easy to identify trendline liquidity. So the overall target was down at this midpoint of this central liquidity zone, this trend line over here. And this trade essentially ran to, I believe it was a 1 to 2.3. Yep, 1 to 2, 1 to 3. Essentially, we did have some running room. But the intraday trade itself gave us just over a 1 to 2 hour trade, right? So this is the simplicity of understanding concepts, right? Understanding liquidity, understanding time, understanding your position in the market relative to the weekly opening. One of the most powerful concepts you can introduce to any trading strategy you want to trade in the markets, right? So quick summary, right? We went through order blocks in this video, right? This was our OB over here. This was our order block. What makes this a valid order block? Well, it shifts market structure. We've seen a shift from bullish to bearish market structure. It's left an inefficiency in the New York session, very important to understand. And also prices come into a premium. Prices come into a premium above the 50% level. So if we project this out, notice how prices come above the 50% level, mitigated the fair value gap before heading lower, right? Again, Judas swing, what validates the Judas swing? Well, we swept a previous day high, we swept a session high. Important to understand this. And now we're looking for a liquidity pool over here. Trendline liquidity pool, target the liquidity pool, right? So your trading doesn't have to be over complex, but it's taking a bunch of concepts, putting them together in a story-like fashion, really building that narrative in price. And this is something I preach to a lot of students, right? Build a story in price. Now, what builds a story? It's the basic concepts. You've got liquidity, you have structure or market structure. Timing is very important. Time of day, day of week, position in the market. Now, when we say position, we're referring to that weekly opening price. And also from here, you want to be looking at targets, right? Targets. Where do you want to target in the market? A lot of traders, they get into a trade, but they don't know where to target, and they end up taking break evens or losses, or they don't end up capitalizing correctly on positions they're in. Targets. Now, what determines targets? Well, it's all the things above: liquidity, market structure, timing, positions, fair value gaps. All of these things come in conjunction with each other to produce high probability A+ trade setups, such as the one you see in front of you.